everyone, in this video we are doing Ind AS 37, provisions, contingent liabilities and contingent assets. All the important concepts and study material illustrations will be covered in this. So let's quickly get into this standard. So it's a very easy, manageable, comfortable standard yet frequent in exams. Before understanding the concepts, I'll give you an example. X Limited. X Limited, a car manufacturer. X Limited received on 25th March 2025, 1 week before the reporting date, X Limited got a legal notice from Y Limited. Y Limited is a competitor. Y Limited has sued X Limited against infringement of copyrights or a design or a patent, whatever. Now, X Limited has to pay 25 crores to Y Limited. X Limited will naturally appoint, because getting a legal notice means we have to move legally. Yes or no? So, in the books of X Limited, what should be the accounting? What do you think? In the books of X Limited, what should be the accounting? In the books of X Limited, whether provision requires to be created or contingent liability requires to be disclosed, and in the books of Y Limited, whether Y Limited recognize a contingent asset. In exam, if we get a situation like this, we will write the provision. When do you create provision? When do you create provision? Provision is an estimated liability. Yes or no? So, when do you create provision? Present obligation. Provision is created when there is present obligation arising out of past events. Present obligation arising out of past events. Outflow of economic resources. Resources embodying economic benefits. Money or money's worth. Outflow of economic resources are probable, and best estimate can be reliably measured. Estimate can be reliably measured. According to our legal counsel or legal advisor, advocate, that 20 crores is payable. 25 crores is the compensation, of which 20 crores is to be paid anyway. Then you create provision, create expense or loss debit to liability, provision for compensation payable, create provision P&L to provision for that compensation. So what is provision? Provision is an estimated liability. Provision is an estimated liability and provision should be recognized in financial statements. If it is expected to be settled in 12 months, short-term provisions. Expected to be settled more than 12 months, long-term provision. Okay. Now, provision is a liability? Yes. Provision is a liability. So, all liabilities are provision? No. All liabilities are not provisions. Liability means a loan is a liability. Do you have uncertainty in fixing the amount, estimating the amount? If you have taken a loan or if you are a lessee, lease liability to be paid, do you have uncertainty in identifying the amount? No. So provision means a certain element of uncertainty is also there. Okay. Now, how do we calculate the best estimate? You said best estimate can be reliably measured. How do you calculate the best estimate? If there are many possible outcomes, in the example which we were saying, see, 25 crores is the claim, but there is a possibility that we may have to pay. There is a possibility that we may have to pay 20 crores, or we will be able to settle in 15 crores, or we will be able to settle in 20 crores. There are three possible outcomes or many possible outcomes. It can be 20, it can be 15, it can be 10. Then what will be taken as the provision? What is the amount we will create as provision? If there are many possible outcomes, like what we have learned in Ind AS 115, you can go for expected value method. Expected value method. What is expected value method? Probability weighted average. Expected value is nothing but we are going for probability weighted average. What is this probability weighted average? That is 20 crores. What is the probability to pay 20 crores? 60%. What is the probability to pay 15 crores? Say 15%. I'm just taking random numbers. 10 crores, there is 25% probability. So you find out what is the probability weighted average and accordingly find out 20 into 60%, 15 into 15%, 10 into 25%. Take the total. That is the probability or that is the provision to be created. Okay. If there are only two outcomes, if there are two outcomes are possible. If there are only two outcomes. If there are two outcomes possible, then we'll go for most likely method. What is most likely method? We'll take 20 crores and 15, say for example, 20 crores, 60% probability and 15 crores, 40% probability. But only two outcomes are possible. Then according to the standard, it is not our creativity. According to the standard, you should create provision for that amount, that outcome which is having the highest probability. Okay, 20 crores. Fine. Now, what if the expenditure or the loss or the claim is expected to be settled after 12 months? There is a possibility, there is a present obligation, but the liability is expected to settle after 12 months. Then we take the discounting. Then provision should be discounted using pre-tax discounting rate. Pre-tax rate. Use pre-tax rate and compute the present value of that liability provision. Whenever, so we create P&L to provision at P&L or that expense or loss to provision we created. Pass the journal entry at present value. Whenever there is discounting, there is unwinding. So if you have calculated the amount at present value, as the time passes, at the end of each reporting date, you need to unwind the provision. What is the entry for unwinding the provision? Interest to provision. Yeah, interest. So if discounted, then it should be unwinded. Easy. Okay. Provision should be reviewed. Maybe after 1 year, this case is going on, and after 1 year, we are almost certain that we will win the case. Or we are almost certain 20 crores will not be the provision, we have to pay 25 crores. Then provision should be reviewed at each balance sheet date to reflect the current best estimate. Every year you need to calculate this. This exercise should be continued. You should calculate the provision, and if not required, you can reverse it to P&L. Reverse to P&L. Easy. Okay. Then, when do we create provision? When there is present obligation. Provision is created when there is present obligation. Provision is created when there is present obligation. Present obligation can be a legal obligation or a constructive obligation. What do you mean by legal obligation? Out of law, out of statute, contract. You already entered into a contract, then you have legal obligation. Or written policies, then it becomes a law, it becomes a rule. Therefore, there is legal obligation. Or then provision required to be created for constructive obligations also. That is informal past practices or customs, or there are commitments. It's informal, it is not written, it is not law, it is no contract, but there is a commitment. And there is no realistic alternative. You cannot skip the payment. There is no realistic alternative than paying the amount, paying the obligation, then create provision. Create provision for legal as well as constructive obligations. Create provision for legal as well as constructive obligations. Understood. Onerous contract. What is an onerous contract? See, as per Ind AS 37, provision is not required to be created. Provision should not be created for executory contracts unless it is onerous. Provision is not required to be created for executory contracts unless it is onerous. What do you mean by executory contracts? Executory contracts means contracts which has not executed by both the parties. Buyer and seller has not executed, or a contract where one party has executed 40% and the other party has also settled 40%. Equal amount has been executed by both the parties. Equal extent. You worked 40% and I paid you 40%. So to the equal extent the work is done. That is an executory contract. So provision is not required to be created for executory contracts means future execution is on a future date. For future operating losses, no provision is required to be created. For future operating losses, no provision is required to be created. For future operating losses, no provision is required to be created. However, if the executory contracts are onerous, what do you mean by executory contracts are onerous? Onerous contracts means what? Onerous contract means unavoidable cost of meeting the obligation is more than economic benefits. I entered into a contract, okay, but if I do the contract, there will be a loss of 20 lakhs, or there will be a cost of 20 lakhs, cost of 20 lakhs, cost 20 lakhs. And the economic benefits I'm expecting is only 5 lakhs. Oh, then it is going to be a loss, right? Future, that contract is going to happen in that if I execute 20 lakhs expense I need to incur, and the economic benefits from the contract is 5 lakhs. So we are saying, okay, in such a case, why don't you exit from the contract? If I exit from the contract also, there will be termination penalty. So the standard says, if the contract is onerous, so what is onerous contract? The unavoidable cost of meeting the obligation is more than the economic benefits. In such a case, provision should be created for, yes, provision should be created for loss of fulfilling the contract. If I fulfill the contract, it is going to be a loss of 15 lakhs. If I am not fulfilling the contract, there will be termination penalty, termination penalty, termination penalty. In case of termination, what is the termination penalty? Termination penalty, say for example, 3 lakhs. Then it is better to exit from it. Only 3 lakhs will be your loss. Create provision for this 3 lakhs. You can create provision for 3 lakhs. You can create provision for 3 lakhs. Onerous contract, if you can prove, create provision for the lower of loss of fulfilling the contract and penalty of non-performance of contract now. That's with regard to onerous contract. So if there is an estimated liability in future, estimated expenditure in future, and there is present obligation, you create provision. And you created provision of, say for example, 10 lakhs, not in this case, generally. Now, if risk exists, that the actual outflows would be more than expected, then increase expected present value of outflow with the risk factor. There is a 10% chance that the actual may vary with the expected. Then you 10% increase provision. Okay. If there is an expected gain, for example, when we are creating provision, you are expecting a gain. When you are creating provision, you are expecting a gain on sale of asset. Can you consider in fixing or identifying the provision amount? A big no, should not include. If that provision liability can be avoided by future actions, then no need to create provision. No need to create provision. No need to create provision. Okay. Future only there can be a liability, but future I can avoid it. Then what? Don't create provision. Okay. Now restructuring. Restructuring. So what is this restructuring? It's a plan to change the scope or manner in which the business is conducted. Maybe shifting the location from one place to another, or stopping, terminating some lines of business. So some best examples is that Kerala Spices Limited, a leading exporter of spices in Kerala. They have gone for business restructuring where they closed a loss-making factory in Alleppey. They laid off almost 50 employees and they relocated the headquarters to a smaller facility in Ernakulam, and they have written off some obsolete machinery. So it's like there is a restructuring. How the business was conducted before and how the business will be conducted after will be different. So in such a case, when do you create provision? Provision is created. So when do you create provision? Provision is created when one entity has a detailed formal plan. The entity has a detailed formal plan and the plan is announced. There is a detailed formal plan and the plan is announced. We are closing our headquarters, we are closing a business in Alleppey, closing a factory in Alleppey, and 50 employees will be laid off. It has been announced and it has created, there is a proper formal plan, proper documentation, that plan is announced and it has created valid expectation in the minds of those employees who will be laid off. They will be getting some termination benefits that was there in the plan, and the plan is announced and it has created some expectations in the minds of those who are affected by the plan. Then what the standard says is provision is required to be created. Provision is required to be created. Provision is required to be created only for the direct expenditures arising from restructuring, like this termination benefits, direct expenses incurred for relocation. Let's try a question from the study material so you can identify what the examples of direct expenditures. Because of restructuring, what are the expenditure that you may have to incur? Okay. And relocation expense, retraining cost, etc. are not considered as direct expenditures. Otherwise also, if there was no restructuring also, there will be impairment expense, impairment loss. The asset is already obsolete. So that cannot be considered as direct expenditures of restructuring. So direct expenditures include this termination benefits payable, or maybe consultancy fees you paid, fees expected to be paid for this restructuring, closing of a lease agreement. I was using a building because I'm shifting my business. That building is no more required. So there is a lease liability. There is a again a early termination to be paid. So termination penalty to be paid. Maybe that these are the examples of direct expenditures. Okay. Now, very important area, reimbursement assets. What do you understand by reimbursement assets? That is, I am incurring an expenditure. I am expected to incur an expenditure. I am expected to incur an expenditure. Okay, I am expected to incur 50,000 as expenditure. for which there is present obligation, there is outflow of resources are probable, and reliable estimate can be made. So we need to create provision on that 50,000. And out of that 50,000, 30,000 can be reimbursed. 30,000 can be reimbursed. We will be getting reimbursement from an outside party. Then recognize as separate asset in the balance sheet if it is virtually certain. If you are sure, virtually certain. What is virtual certainty? More than 95% chance that the reimbursement will be received, then create it as a separate asset in the balance sheet. Okay. In P&L, so in the balance sheet, 50,000 appear as provision and 30,000 will appear as a reimbursement asset receivable. In P&L, you can set off. Provision expense and reimbursement income can be set off. Then remember, reimbursement asset should not exceed liability. Like indemnification asset should not exceed contingent liability. You have studied in business combination. Same concept, asset shall not exceed the liability. Okay, now there are some key terms which we need to study. When you see, this is a standard which requires estimation. Probability, we need to identify. If the probability is up to 5%, we call it as remote chance. Do not recognize contingent liability, do not recognize provision or do not disclose contingent liability. Remote chance, do not recognize provision, do not disclose contingent liability. If it is up to 50%, we call it as less probability or possibility. Less probability. 50% and more will be considered as more probability. And more than 95% is what called as virtual certainty. Virtual certainty. Up to 5%, 5 to 50%, 50 and more than 95%. Okay, what is the importance of this? Yeah, we are going to see this. Why do we need to understand that slab? Why do we need to understand that slab? Yeah, we are coming to this. What are contingent liabilities? So when do we create provision? We create provision when there is more than 50% probability that we may have to settle that liability by paying cash or money's worth. Then if there is less than 50% probability, there is possible obligation arising out of past events. Possible obligation. And very important, it is confirmed by occurrence or non-occurrence of uncertain events. Occurrence or non-occurrence of uncertain events. Okay. Outflow of resources, outflow of economic resources is less probable. We are fighting against that case in the court, and there is a higher possibility that we will win the case, lower possibility that we will lose the case. What if we lose the case? Outflow of resources embodying economic benefits will be probable, but it is less because more possibility is to win, and best estimate cannot be reliably measured. We believe that we will win the case. In such a case, disclose contingent liability, but no disclosure of contingent liability is required. No disclosure of contingent liability is required. No disclosure of contingent liability is required if the probability is less than 5%. Remote cases don't disclose. If remote case, don't disclose contingent liability. Okay. Then what are contingent assets? Contingent assets are possible assets confirmed by occurrence or non-occurrence future uncertain events. Do you recognize contingent asset? If there is virtual certainty more than 95%, recognize. Record asset. we will pass receivable or asset, whatever, to P&L. It is not a contingent. 95, more than 95% assurance you recognize. 50% and more, then disclose. Less than 50%, do not disclose. Do not disclose. There is no question about recognition. Okay, understood. So very easy area. These are the areas we have discussed. What is a liability? Liability is present obligation arising out of past events, and there will be outflow of resources upon settlement. Provision. All liabilities are provisions? No. All provisions are liabilities, because provision includes uncertainty, and provision is created. There are 3 points. Present obligation arising out of past event, outflow of resources embodying economic benefits are more probable, and best estimate can be reliably measured. Measurement. This will be, if there is more than 2 outcomes, then we go for expected value method, or else we will go for most likely method. No provision is required to be created for future operating losses. Executory contracts. However, if executory contract is onerous, then we do recognize provision. Whichever is lower. Whichever is lower, A, loss of fulfilling the contract, and the penalty for non-performance of contract. Restructuring. Restructuring is a plan. It is a detailed formal plan which changes the scope and manner in which the business is conducted. Okay. Create provision if there is a detailed formal plan and the plan has been announced, and that created valid expectations in the minds of those who are affected by the plan. Create provision. Only for the direct expenditures related to that restructuring. Reimbursement asset. Reimbursement asset can be recognized. Reimbursement asset is, the treatment is more like a contingent asset, right? If it is virtually certain to be received, then recognize reimbursement asset. Asset should be shown separately in the balance sheet. Liability will be shown separately. However, in the P&L, you can net it off. Okay, fine. Contingent liability. It's a possible obligation arising out of a past event. It is confirmed by occurrence or non-occurrence of future uncertain events. Estimate cannot be reliably measured. Less than 50% probability for outflow of resources. Contingent assets. Contingent assets are assets which are possible, but it depends on, again, the occurrence and non-occurrence of future events. Future uncertain events do not recognize. If it is less than 50%, less than 95%, more than 95% virtual certainty, up to 50, you will 50% and more, you will disclose. Up to 50%, no disclosure also. Okay. Now, what are the questions in the study material? Let's find out. Illustration number 1. ABC Limited is an automobile component manufacturer. The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty. As on 31st March, the reporting date, the manufacturer has a delivery scheduled for June 2012. So you are in 31st March 2011. You have a delivery scheduled on 30th June or June 2012. However, the manufacturer is aware that he will not be able to meet the delivery schedule in June 2012. He is sure that he will not be able to meet the delivery schedule. However, you are sure that you will not be able to meet the delivery schedule. In such a case, you will be having a penalty. So, whether the entity needs to create provision on 31st March 2011, not required. Why not required? Because you are standing on 31st March 2011. On 31st March 2011, is there a present obligation? There is no present obligation. Obligation will be only in the month of, only in 2012. You are in 2011. You have the obligation to pay penalty only in June 2012. future, so there is no present obligation to pay penalty. There is no obligation in the current year. Are you clear? So no need to create, not even in the next year. 31st March 2012 also there won't be any obligation. In June 2012 only there will be obligation. So no, don't create provision. So what is the answer? In this case, there is no present obligation arising out of past event as the goods are scheduled for delivery in June. There is no delay in 31st March 2011. There is no present obligation. There is no present obligation to recognize provision. Easy. Now, this fittings, mock, filters, staff retraining, all this type of questions were there from interlevel onwards. Again, this is a famous question. You all might have done this question before in your intermediate level, but still, as long as it is there in your study material, it can be tested for exam. So listen, X Shipping Limited is required by law to overhaul its shipping fleet once in every 3 years. The company's finance team was of the view that recognizing the cost only when paid would prevent matching of revenue earned all the time with certain cost of large amounts which are incurred occasional. Thereby, it has formulated an accounting policy of providing in its books of accounts for future cost of maintenance, overalls, annual inspection by calculating a rate per hour sailed on sea and accumulating a provision over time. The provision is adjusted when expenditure is actually incurred, whether the accounting policy of X Shipping Limited is correct. So what should be your answer? Your answer is provision is created only when there is a present obligation on the reporting date. On the reporting date, for example, if I acquired a ship and I am doing the sailing, do I have present obligation on at the end of first year? No. Will there be present obligation at the end of second year? No. Only once in 3 years means after 3 years, if you are still sailing without this overhauling, then you need to create provision for the expected consequence, penalty for not doing the overhauling. But at the end of first year, do you need to create provision? No. Second year, do you need to create provision? No. If you sell this ship in the third year beginning, will this liability, whether you need to incur this liability or expenditure? No. Yes or no? You are not required to incur this liability or expenditure if you sell the ship after 2 years. So this is not a liability. This is not a present. There is no present obligation. Therefore, do not require to create provision. And whatever done by the company is wrong. Here it is given. It has formulated an accounting policy of providing in its books of accounts for future cost of maintenance by calculating. Future cost of maintenance cannot be recognized now as an expense. Only current year expenditure can be recognized as expense in the current year. So whatever is done is wrong. We have written here, if an entity can avoid any expenditure by future actions, then no need to create provision. After 3 years, there will be an expenditure. But within 3 years, if you sell the ship, there is a future action of sale of ships, then no need to create provision. Okay. Then X Chemical Limited is operating in the vicinity of a river since 20 years. A community living near X Chemicals Limited claims that its operations has caused contamination of drinking water. X Chemical Limited has received notice from the governmental environmental agency that official investigations will be made into claims of pollution caused by the entity. You are continuously polluting and you are not cleaning this water. Now there is an investigation against you. If it is found that X Chemical Limited has caused contamination, then penalties and fines would be levied on it. X Chemicals Limited believes that it has implemented all environmental safety measures to an extent that is unlikely to cause pollution. Management is not sure whether it has all the information about the entire 20 years. Therefore, neither the management nor the external experts are able to assess X Chemicals' responsibility until the investigation has completed. In such a case, how should management of X Chemical Limited account for a liability? So you are operating for last 20 years. You are contaminating the drinking water, and there is a investigation against you now, and you believe that you do all the environmental safety measures, so there is no liability for you. Now the management and external experts are not able to assess whether you are responsible, which means best estimate cannot be reliably measured. Then do you need to create provision? So what I'll write in exam, um, we'll write as per Ind AS 37, provision will be created when 1, 2, 3. So here from the question, in the given case, the available evidence does not support the conclusion that present obligation exists. However, there is a possible obligation. Therefore, management should disclose a contingent liability for potential penalties and fines that may be imposed if contamination is proved. Less than 50% probability is there, then you disclose it as a contingent liability. Okay, yes. Illustration number 4. X Limited has entered into an agreement with selling agent Y, in accordance with which X Limited has to pay a base percentage of commission on export sales, and additional commission is to be paid if the export incentives are received. X Limited has to pay two commissions. One is base percentage of commission on export sales and additional commission if export incentives are received. As per the accounting policy of X Limited, it recognizes export incentives when actually realized on account of the uncertainty in realizing such incentives. Okay. Export incentives have not been received for the year 11-12. However, X Limited is hopeful of receiving the export incentives in 12-13. State whether in financial statements for 11-12, should X Limited provide for both base commission and additional commission? See, if there is base commission on export sales, you need to create provision. If there is export sales in 2011-12, that commission has to be paid anyway. So you need to create provision for the base commission. But export incentive is required to be paid additional commission only when the export incentive has received. So do you think from the information that export incentive commission to be created in 11-12? No. Only on the amount received only commission to be uh, paid. So no provision to be created for export incentive commission. So far as the base percentage of sale commission is concerned, it is a present obligation. Sales are made, then single commission is to be paid. However, the base percentage of sales commission should be provided. In respect of additional commission, only if it is received. Hence, no provision for additional commission is to be required to be created in the year 2011-12. Okay. So, when do we recognize provision? Present obligation, legal or constructive. As a result of a past event, outflow of resources is required. Reliable estimate, create provision. Otherwise, do not create provision, create contingent liability. But if the probability is less than 5%, do not recognize contingent liability as well. Contingent liability. Contingent assets. Virtual certainty recognizes it. Okay. How do we create best estimate? This expected value, most likely method, all risk and uncertainties should be added, percentage should be added to the expected provision. If it is expected to be settled more than 12 months, create present value. For future events, future losses, do not create provision. But if you expect expected gain should not be considered, should not be taken for the calculation of provision amount, but expected loss, if any, definitely will be taken. That's it. Now, illustration 6. X Solar Power Limited, a power company, has a present obligation to dismantle its plant after 35 years of useful life. X Solar Power Limited cannot cancel the obligation or transfer to third party. So you have an obligation. You have an asset and you need to dismantle the asset after 35 years. It has estimated the total cost of dismantling 50,000 and the present value is 30 lakhs. Based on the facts and circumstances, X Solar Power considers risk factor of 5%. So you add it. How much is the present value of obligation? Present value of obligation is estimated as 30 lakhs plus 5%, 1,50,000. So for that, estimated risk should be added to the provision. Yes. ABC Limited has an obligation to restore the seabed for the damages it has caused in the past. If it has to pay 10 lakhs cash on 31st March 13 related to this liability, ABC Limited's management considers that 5% is appropriate discounting factor. Too basic. Just discount it. Future events will be ignored. X Chemicals Limited, engaged in chemical industry, causes environmental damages by dumping waste in the river near its factory. It does not clean up because there is no environmental legislation requiring cleanup. Nice attitude, right? We are not cleaning up because there is no legislation requiring cleaning up. X Chemicals Limited is causing damage for last 40 years and I'm doing this for last 40 years. As at 31st March 12, the state legislature has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated. The formal Gazette notification of law is pending. Comment on how should X Chemicals deal with the situation. You know what you should write? If there is, for creating provision, you need present obligation. However, if there is no present obligation, but a proposed new law will be enacted, a proposed new law will be enacted and it is virtually certain, the line is virtually certain that the law will be enacted, then create provision. So today there is no present obligation, but it is virtually certain it will be enacted and that liability, there will be liability, then you create provision. So what is the answer? The obligating event is the contamination of water, and because of virtually certainty of the legislation requiring cleanup and outflow of resources is certain, it is possible to arrive at best estimate cost for the cleanup activity. So provision should be recognized. Easy. Expected disposal of assets. What is given? Gain on expected disposal of assets should not be taken. Okay. Instead, an entity should recognize gain only at the time of sale as per Ind AS 16. If there is an asset, only upon the sale of asset as per Ind AS 16 you should recognize gain. Okay. Reimbursement. This is something which we have already discussed. Okay. 9. Question number 9. X Beauty Solutions Limited. X Beauty Solutions Limited is selling cosmetic products under the brand name B, but it is getting its product manufactured from Y Limited. It has an understanding with Y Limited that if company becomes liable for any damages, for any damage claims due to any injury or harm to the customer of the cosmetic products, 30% will be reimbursed to it by Y Limited. During the financial year 11-12, an estimate of the claim 30 lakhs may be payable to the customer by X Beauty Solutions. How X Beauty Solutions Limited account for the claims that becomes payable? So we have learned X Beauty Solutions is selling cosmetics under its brand name B. but products are manufactured by Y. There is an enforceable agreement, means virtual certainty. In case of a claim, 30% will be borne by Y or reimbursed by Y. Then how that reimbursement will be recognized? Reimbursement asset should be recognized as a separate asset in the balance sheet, receivable to P&L. You create receivable to P&L. Here there is a provision of loss of 30 lakhs. Create provision for 30 lakhs. Create reimbursement asset for 9 lakhs. Net 21 lakhs can be shown in the P&L. P&L 21 lakhs can be shown. In the P&L you can net it off and show it as 21 lakhs. In balance sheet you show it as a separate asset. Receivable separate, provision separate, but in P&L you can net it off. Okay, there is virtual certainty because there is an enforceable agreement. Okay, so provision should be reviewed at the end of each balance sheet date if there is a change in provision. Okay. 10. X Telecom Limited has income tax litigation pending before appellate authorities. Legal advisor's opinion is that X Telecom Limited will lose the case and estimated that the liability of 1 crore may arise in 2 years. A liability of 1 crore may arise in 2 years, which means the liability is expected to settle after 12 months. So, for which we need to create provision at discounted value. The liability is recognized on discounted basis. The discount rate at which the liability has been discounted is 10%, and it is assumed that discount rate does not change over a period of 2 years. How Telecom Limited calculate the amount of finance cost? Come on, this is so simple. For somebody who has studied financial instrument leases in AS 116, this is a cakewalk, very easy. So first we create provision, P&L to provision, or that expense to provision. How much? 1 crore, 100 lakhs into discounting rate at 10% for 2 years, 0.826. 82.6 lakhs. You create provision. As the time passes, at the end of the next reporting period, we pass the entry interest to provision. How much? 82.6 into 10%, 8.26. 8.26 or 8.3. Okay. Now year 2, last year, again interest to provision with the balancing figure. Final amount should be 100 lakhs. 100 lakhs minus 82.6 plus 8.26. For the difference, we create finance cost, expense, and then provision to bank. Once you settle it, provision to bank. Very easy, right? Just go through the answer. Nothing more than that. Whatever we have discussed is enough. Okay. Then that was question number 10. Question number 11. X Packaging Limited has 2 segments, packaging division and paper division. In March 2011, the board of directors approved and announced a formal plan to sell the paper division. So, discontinuing operations, they have already approved and announced a plan. Okay. So, in March 2011, the board of directors approved and announced a formal plan to sell the division in June. So, you announced on this at the end of the reporting date, you have made the announcement. Operating losses of the paper division are estimated to be 50 lakhs during the period from 1st April 11 to the expected date of disposal. Future operating losses for that year in 31st March 2011. Future operating losses expected is 50 lakhs. What do you think? Do you need to create provision for that 50 lakhs? Management of X Packaging wants to include the future operating loss of 50 lakhs in provision. So, can you create provision for that? No. Provision should not be created for, provision should not be made for future operating losses. Therefore, should not include this in operating losses. Okay, fine. Easy. Onerous contract. Yes, we have discussed what is onerous contract. Question number 12. X Metals Limited had entered into a non-cancellable contract with Y, which means I cannot withdraw from this contract, to purchase 10,000 units of raw materials at 50 per unit. So yes, 5 lakhs. As per the terms of contract, X Metals Limited would have to pay 60,000 to exit the said contract. X Metals Limited has discontinued manufacturing the product that would use the said raw material. For that, X Metals Limited has identified a third party to whom it can sell the said raw materials at 45. So if I purchase the units at rupees 50, I can sell at 45, which means what is my loss if I fulfill the contract? If I fulfill the contract, loss will be 50,000. What will be the loss if I am exiting from the contract, non-performance of the contract? 60,000. For onerous contract, you need to create provision for A and B, whichever is less, 50,000. Therefore, provision should be created for 50,000. Okay. Now restructuring. Question number 13. Very easy. Here there is constructive obligation. This question is not worth for us to read fully, and there is constructive obligation by announcing the plan. So this question is not worth for us to read fully. A detailed formal plan for shutting down the above unit was formalized and agreed, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred. By making that announcement, number of employees whom this will be compensated will definitely create valid expectations in the minds of those who are affected. Therefore, provision should be created. Constructive obligation is there. Conditions are, there should be a detailed formal plan which should have raised valid expectation in the minds of those who are affected. Okay. Therefore, the board of directors did discuss and formalize a formal plan. This plan was communicated to the parties and created valid expectation in their minds. Therefore, if they would go ahead with this plan, constructive obligation needs to be provided at the year end. Easy. Then I think there is last one more question, 14. A manufacturer gives warranties at the time of sale to purchasers of its 3 product lines. Under the terms of the warranty, the manufacturer undertakes to repair or replace items that fail to perform satisfactorily for 2 years from the date of sale. At the end of reporting period, a provision of 60,000 has been recognized for the sale made during the year. The provision has not been discounted as effect of discounting is not material. Draft the note. So what is the note? See, from this question, that contents has to be written. Draft the note. So provision has been created as 60,000. Warranty is given for 2 years from the date of sale. At the end of the reporting period, as the discounting effect is immaterial, provision is not discounted. Maybe the expenses expected to incur in the next financial year within 12 months. It is not discounted. Just we need to write a note. Provision of 60,000. There is no decision making, suggestion, calculation involved. Has been recognized. It is assumed that majority of the expenditure will be incurred in the next financial year. And it will be incurred within 2 years from the reporting period. And as the effect is immaterial, discounting effect is immaterial, the expense has not been, the provision has not been discounted. You can just write a note. That's it. This will take care of the illustrations. Now test your knowledge questions. All these questions are, there are 6 questions. All these questions are manageable actually, but I'll read quickly. X Limited is operating in the telecom industry. During the financial year 11-12, the income tax authority sent a scrutiny assessment notice. Okay. X Limited is in the telecom industry. During the year, income tax authorities send a scrutiny assessment notice under section 143(2) in respect of return filed under section 139 for the previous year, and initiated assessment proceedings on account of deduction claimed by the company, which is in view of the authorities was inadmissible. So thing is clear. There is an inadmissible expense, but you have claimed a deduction. So accordingly, you paid less tax. So they have raised a demand. During the financial year 11-12 itself, the assessment proceedings were completed and the assessing officer did not allow the deduction and raised a demand of, oh my god, 1 crore. The company contested such a levy and filed an appeal with the appellate authority. At the end of the financial year 11-12, the appeal had not been heard. The company is not confident whether the company would win the appeal. However, the company was advised by legal counsel that on similar matter, two appellate authorities of different jurisdiction had given conflicting judgments, one in favor of the assessee, one against, which means we are in a dilemma whether we'll win or lose. Legal counsel further stated that it had 50% chance of winning the appeal. So 50% chance of losing the appeal. So no. Advise whether the company should account for these transactions in the financial year. How should this be accounted? What do you think? Whether we need to create provision or whether we need to create contingent liability. Less than 50% is less probability. 50 and more is more probability. Therefore, there is 50% probability that we will lose the case. Therefore, we need to create provision. Should create provision for this entire 1 crore. We need to create provision for, there is 50% and more chance to lose the case. Therefore, we need to create provision for 1 crore. Okay. An entity is a telecom operator. Laying of cables across the world is a requirement to enable the entity to run its business. Oh, it's a requisite, it's necessary. Cables are also laid under the sea and contracts are entered into for the same. By virtue of laws of the countries through which the cable passes, the entity is required to restore the seabed at the end of the contract period. State the nature of obligation that the entity has in such a case. By virtue of laws of the countries through which the cable passes means what? You have legal obligation to restore. You have, so what is the answer? Just read it. Entity has a present obligation, reliable estimate. The entity is required to restore the seabed at the end of the contract period. So wherever you have laid the cables, you have the legal obligation to restore the seabed. So create provision. So how do I present my answer as per Ind AS 37? Write what is provision, 3 lines of provision. Then in the given case, the company is having legal obligation. And just write the contents from the question. By virtue of law, we'll write this line. So wherever the company has laid the cables, provision should be created for restoring the cost of restoring the seabed. Are you okay? Then, so let's read this question number 3. U Limited is a large conglomerate with number of subsidiaries. Okay, big company. It is preparing CFS as on 31st March 2012. The financial statements are due to be approved on 15th May. Following are few transactions that have taken place in some of the subsidiaries during the year. G Limited is a wholly owned subsidiary of U Limited engaged in management consultancy services. On 31st January 2012, Board of Directors of U Limited decided to discontinue the business of G Limited from 30th April. Okay, one of the subsidiaries of U Limited is G, and now we are planning to discontinue the business. They made a public announcement of their decision on 15th February 2012. Before the reporting date, they announced their decision of discontinuance, which means conditions were existing on the reporting date. G Limited does not have many assets and liabilities, and it is estimated that the outstanding trade receivables and payables would be settled by 31st May. U Limited would collect any amount still owed by G Limited's customers after 31st May. They have offered the employees of G Limited termination payments or alternative employment opportunities. If there is a detailed plan and the plan has been announced, then it has created valid expectations. So here, termination payments or other employment opportunities. Following are some of the details relating to G Limited. On the date of public announcement, it is estimated that G Limited that it would have to pay 540 lakhs as termination payments to employees, and their cost of relocation would be 60 lakhs. What do you think? Provision should be created for we promised only termination payments or alternative employment opportunities. But relocation cost, we will not create provision. The actual termination payment totaled 520 lakhs were paid in full on 15th May. So what is the, the financial statements are due to be approved on 15th May. We initially estimated termination payments to be 540, and on or before 15th May we settled 520, which means we need to create provision for 540 or 520. We need to create provision for 520. Then for relocation expense, we will not create provision. As per latest estimates made on 15th May, the total relocation cost is 63 lakhs. We will not recognize a provision for relocation expense. G Limited had taken a property on lease, which was expiring on 31st March 16. The present value of future lease rentals is 430 lakhs. On 15th May, G Limited made a payment to the lessor for 10 lakhs in return for early termination of the lease, which means at the time of discontinuing the operation, I was giving you an example. We had a factory. If the factory was on lease, I'm cancelling that lease agreement early, on which I have to pay termination penalty. So I had to pay for 10 lakhs on 15th May. On 31st March, when we are, we will identify this as an adjusting event, as the condition was already existing on the balance sheet date. Therefore, we create a provision for 10 lakhs. So, loss after tax of G Limited for the year ended 31st March 12. Our reporting period is on 31st March 2011. Next year loss is 400 lakhs. G Limited made, no. We are closing, our reporting date is 31st March 2012. Already there is a loss of 400 lakhs. They made further operating loss of 60 lakhs till 30th April 2012, which we will not. See, we will not provide for. See, on 31st March 2012, discontinuation is already announced. So that discontinuation related expense can be recognized. Termination, anyway benefits are to be paid, create provision. Lease agreement anyway to be cancelled, therefore create provision. But next year's, on 31st March, there is no present obligation to have a loss of 60 lakhs. No, don't create provision for future operating loss. 31st March 2012, next month's loss should not be provided. So we need to create provision for 520 plus 410. 930. How should I present my answer? First you write restructuring provisions, notes. When do we need to create provision? And for relocation expense, retraining expense, starting expenses of business in the new area, marketing of business in the new area, or new business marketing cannot be considered as restructuring. Direct expenditures related to restructuring. Only what benefits you have promised to the lead of employees, or that expenditure that is directly related to restructuring only can be considered as expense to be incurred and related to restructuring, for which provisions should be created. Provision can be created only for those expenses which are directly related to restructuring. Okay. Now 456. 4. A company manufacturing and supplying process control equipment is entitled to a duty drawback if it exceeds its turnover above a specified limit. Okay. To claim duty drawback, the company needs to file application within 15 days of meeting the specified turnover. Once I reach, if 100 crores is the specified turnover, if I reached 100 turnover in 31st October, within November 15th, I need to file to claim. I should claim, file application with this. Okay, fine. If application is not filed within stipulated time, the department has discretionary power of giving duty drawback credit. If you are not doing on time, it is upon us to decide whether to give or not. For the year ended 11/12, the company has exceeded the specified limit of turnover by end of the reporting period. However, duty drawback can be claimed on filing of application within stipulated time or on discretion by the department. The application for duty drawback is filed on 20th April. Oh, 31st you uh, achieved the target, and that specified performance target is achieved, but you have to file within 15th April, but you filed on 20th April. Duty drawback has been credited by the department on 20th June, but luckily uh, department has given you the credit, and the financial statements were approved on 26th July. So whether you need to recognize contingent asset. On 31st March, were you virtually certain to receive? You have not filed the application. So were you virtually certain to receive this? No. And you have not filed the application also. Therefore, you should not recognize contingent asset. You should not recognize contingent asset. So, in 2011-12, you have achieved the turnover, but you have not filed. So, you have filed only on 20th April. What you can do is, you can disclose it as a contingent asset. But only when it is virtually certain to receive. Can you recognize contingent asset as receivable? No. Contingent asset as receivable? No. So there is no virtual certainty that it will be received on 31st March. Moreover, you have not filed it. So it cannot be recognized as income. It can be recognized as income in the next year upon when it is received. Then if there is 50% and more probability that it will be received, then you can disclose it as contingent asset on 31st March. First year, you can disclose it as contingent asset if there is 50% or more probability. Let's go through the answer. Let's read the answer. In the instant case, condition of exceeding the specified turnover was met. Okay, which means the company can get duty drawback. However, the application for the same has been filed after the stipulated time. Therefore, it is discretionary in the hands of department. Okay. Accordingly, duty drawback is a contingent asset at the end of the reporting period, which will be realized when the department credits the same. Then only if it is virtually certain it can be recognized. Okay. In accordance with the above, duty drawback, which was a contingent asset for 11/12, should be recognized as asset and related income in the next year when it is virtually certain. Easy. Okay. Entity XYZ entered into a contract to supply 1,000 television sets for 2 million. An increase in the cost of inputs has resulted in an increase in the cost of sales to 2.5 million. The penalty for non-performance of the contract is expected to be 0.25 million. Evaluate whether the contract is onerous and also determine the amount. Yeah, it is onerous contract because if I fulfill the contract, there will be a loss of 0.5 million, or else there will be a loss of 0.25 million. Whichever is lower, 0.25 million. You create provision for 0.25 million. Last. Marico has an obligation to restore the environmental damage in the area surrounding its factory. Expert advice indicates that the restoration will be carried out in two distinct phases. First phase requiring expenditure of 2 million to remove the contaminated soil from the area. Okay, you may have to incur 2 million to remove contaminated soil from the area, and second phase commencing 3 years later from the end of first phase to replant the area with suitable trees and vegetation. Okay, so it has an obligation to restore the environmental damage. So first phase is incurring 2 million to remove that contaminated soil. Second phase is to replant the area with suitable trees and vegetation. The estimated cost of replanting is 3.5 million. Marico uses cost of capital before tax, pre-tax 10%, and the expenditure when incurred will attract tax relief of 30%. Okay. Marico has not recognized any provision for such cost in the past, and today's date is 31st March 2012. The first phase of the cleanup will commence in a few months' time and will be completed on 31st March 13 when the first payment of 2 million will be made. Phase 2 will be paid 3 years later from the end of first phase. Calculate the amount to be provided. See, I personally feel all the questions we have discussed is very easy to crack, and normally this is the kind of question we are getting from provisions. So here, what is the amount of provision to be created? So expense which is expected to incur for first phase 20 lakhs, first year discounting factor, 1 year discounting factor. Then 12, 13 if you are incurring expense, then 3 years later 12, 13, 13, 14, 14, 15, 15, 16. Total provision to be created is 42 lakh 8,500. So that's it, guys. This takes care of Ind AS 37 concepts and questions from the study material. So we'll meet in the next video. Take care. Bye.